When you purchase an annuity, there are effectively three decisions that you have to make. The first is, do you have a single or a joint life annuity? Now, of course, a single life annuity will invariably pay out more, but it may be essential to have a joint life annuity depending on your individual circumstances. So, for example, if your spouse has got an index-linked final salary pension that's more than sufficient for their needs, you may not need to include them with your pension provision. But if the pension plan that you have is the majority, if not all, of the pension plan for the family, then it would usually be necessary to build in some form of joint life pension. The second choice that one has to make when purchasing an annuity is, do you have a level or an escalating income? Now, in a utopian ideal, of course, it makes perfect sense to have an escalating income that keeps pace with inflation so that your purchasing power isn't eroded over time. But again, it's essential to look into this option because most people do find that the cost of building in an escalation is prohibitively expensive, and it usually takes, on average, about 20 years before one's better off using that route. So again, absolutely essential to look at those, take advice, and make the right decision. The third choice that one has to consider when purchasing an annuity is whether to build in a guaranteed period. What a guaranteed period does, it guarantees the minimum period that an annuity is payable for, even if the annuitant and any surviving beneficiary are no longer around. So, for example, an annuity that has no guarantee is only payable for as long as one or both annuitants are alive. If an annuity has, say, a 5-year guarantee, the annuity is paid for a minimum period of 5 years, even if the annuitant was to die before then. So it's normally a very, very cheap way of building in some level of protection against a pension fund that you've spent a lot of money accumulating over a working life just disappearing.